Disclaimer. This video was created for professional Forex and crypto traders. Maverick Currencies is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional Forex and currency trader for Maverick, click the apply button in the video description. Let's break down what happened today.
Well, hello everyone and welcome out to your Maverick Currencies FOMC meeting. It's nice to be with you. Corey here with you today. We're going to go through and look at obviously a focus on US dollar charts because the Fed is likely, it's 99.9% probable that they are not going to raise rates. So it's more about the statement. It's more about the press conference. If we take a close look here, the markets are not expecting a rate hike, keeping rates unchanged from the 5.5%. But why is the statement, the press conference, so important? Well, the reason is we don't know what their statement's going to be, and the market is looking out in the future and saying, okay, are we at base rate? Is this where we're going to stay at 5.5? Do we have risk of going higher? Is it going to come down at any point? And remember that the market keeps adjusting. Every step the Fed takes, the market adjusts a little further, and the Fed takes a step and the market adjusts a little further. And what do I mean by that? What I mean by that is that if you look at the way that rates have gone up, at the starting point, one of the things that we always emphasize to our traders is that rates move in trends. You don't go from a holding pattern to one rate hike and then stop. You're going to have more after, but the question is how many more? And the market absolutely did not expect this much. The market kept adjusting. And then they'd raise a little further and the market would have to adjust and say, you know what, there's even more coming. And then there were more coming. And then the market would have to adjust and say there's more coming and so forth. And the market keeps adjusting over and over again to higher rates. And rates have kept going higher. If you were to look at Fed's fund forecasts, the expectations have been that there would be rate cuts later this year. That was certainly the plan all the way back during these cycles. They said, well, the Fed's cutting or hiking right now, but they're going to cut later in 2023. That was the consensus. That was what the markets were expecting, and it's not going to happen. So much so that we're now in September, and the question is there going to be any more hikes? Is there going to be a hike in October, November? Is the Fed on hold? And so the Fed's messaging here is important. If you look at the Fed fund futures, again, they're expecting rate cuts next year. It's this continuous cycle where the market has been really forced in a way to thinking this way because that was the dominant theme in years past. In years past, it was easy monetary policy, money printing, quantitative ease. That was the trend for 15 years, right? So for a long period of time, that was the trend. But times they are a-changing, and 2023 has been a major shift in this. And this is something that I'm trying to emphasize to our traders is, look, we're not going back to where we were. We're not going back to zero interest rates. Now, eventually there will be rate cuts and things of that sort, but these rates are not abnormal. This is more getting back to normal. What was abnormal was the prior 10 years. Having rates down here at zero is so far from normal. It is just completely backwards to good economic conditions. And they got away with it because the U.S. has been in a deflationary spiral. We're very much like Japan in that way, in that we have an aging demographic of baby boomers. Nothing wrong with that. It's not wrong to be a baby boomer, but the reality is that it is an economic drag. That when you have when the majority of your individuals in your country are older, they're not as productive as when they were 20s and 30s and 40s. There's not as much growth. They don't spend as much. They have more costs associated with them, right? We've got to have Medicare and Medicaid, and we got to have retirements and pensions and all these sorts of things. So they've had their productive boom. Well, Japan was like that. Japan has gone through a cycle where they've sold more diapers to adults than babies, and that's, backwards demographics. And what has Japan been fighting? They've been fighting deflation for many, many years, and you've seen the Japanese yen spiral out of control to the downside for many, many years because they just keep printing more and more. They're not worried about inflation. Well, 2023 is such a big year because it's a change in that dynamic. The Fed got smacked in the face. The Fed said, no, inflation is transitory, no problem. It's here today, but it'll be gone tomorrow. And it didn't go away. And inflation kept going higher and higher and higher until they didn't start raising rates. Crazy enough, they didn't start raising rates until CPI was at 7%. The Fed was so far behind. And so what that does is it puts the Fed in a position of weakness. Now inflation has scared them to their core. They lost control of price stability for a while. Inflation was near 10%, and that's a huge risk. That's one of their mandates. So they're willing to sacrifice economic conditions, and they're willing to sacrifice job losses and all those sorts of things to get inflation back to a better number. Well, we've seen it come back to a better number, but just this last report, CPI was up more than expected, and it's nearly 2% higher than their goal, right? Their goal is 2 and it's at 3.7, and it's been creeping up the last couple of months. So does the Fed stay higher for longer? Do they really, as they say, jawbone, and do they talk about how they're going to have to battle inflation and they're not out of the woods yet? I think that's going to be the messaging. I think that has to be the messaging. So I would anticipate, this is speaking fundamentals, we'll let the charts show the story, certainly, but I would expect the Fed statement, and maybe even more importantly, the Fed press conference, which comes 30 minutes later, to be somewhat hawkish. While they're going to say they're data dependent, they're going to really emphasize that maybe they're not done. They're still considering future rate hikes, that they're going to really emphasize that messaging. That's the way I perceive this meeting to go, and I think they have to. I've always compared it to, I like golf, so I compare it to a golfer. When you are standing over the ball and you've got to hit over water and you just plopped one in the water because you didn't have enough club, what are you going to do? Well, you're going to club up, right? You're going to make sure that you clear the water, that you're not going to make the same mistake twice. And the Fed's in that situation. They screwed up inflation. They need to get it over the water, and they're going to club up, meaning if they're going to err, they're going to err on the side of being too hawkish. They're going to err on the side of pushing rates a little too far. They're going to err on the side of speaking to the fact that, maybe they drive down economic conditions and so on to get control of price stability. They'll do that. They're willing to do that. I think they're going to emphasize that point. So normally hawkish and all those sorts of things is actually better for the currency, right? When we think about currencies, one way you can look at this, if we look at central bank rates, you can see that the US is right up there at the top with New Zealand. The British pound, Canada, euro, Aussie, they're all in that same general area. The Swiss franc and the Japanese yen are certainly down there at the bottom in terms of central banks, but the US is right up here near the top. Typically a higher rate, stronger for the currency. The US still has a pretty good economic condition, stronger for the currency. These things are they all tend to be better for the currency as a general rule. And so if we take it from that standpoint, we can come in and let me pull up the chart here. We'll come in and pull up some US dollar charts. Thought I had this up, but maybe not. Let me pull it up here. I've mentioned gold. It happens to be the chart up. I've talked about precious metals the last little while. I think this rally, I mean, we've created a little bit of a bottoming effect. I talked about it on Monday in the currency recap. I think gold is still an upside. It's up a couple of percent since then. Gold looks pretty good. But if we look at US dollars, let's pull up our US dollar chart against all the other currencies. When you look at this particular chart, you kind of say, okay, big picture, we're in an uptrend. We're certainly in an uptrend. Now I can back this out a little ways and we can draw up some different areas of importance, right? Here was a pretty significant pivot high, resistance zone, and we got above it, used it as a support, and we've sprung higher. We're in a little bit of a correction, but the overall trend is still up. I mean, look at the 20 sloping up, the 50 sloping up. So the US dollar selling off right now into the Fed meeting. But the question is, do we think that it's just going to spiral lower, or do we think that there's more upside? Again, I think that the press conference and some of these things could be better for the US dollar. The dominant trend is bullish. The short-term moves are bearish. So that doesn't give us a real happy spot, unfortunately. That kind of puts us in a mode of, you know, you've broken below the 20. Is the short-term momentum going to continue here? Is this a pivot point where we're going to turn back up? I would say there's a couple of good things about this chart in that even if we are moving a little lower, there easily can be a bounce in here, just kind of intraday, to really see if there's more, you know, downward pressure and whatnot. As I was looking through charts, the short term is ugly for the US dollar. We can see that. It's been selling off the last 3 days, right? It's has a little bit of downward pressure. If we come into some of these US dollar charts individually against other currencies, I'm going to leave it on the daily, but what you'll see is here's US dollar against Japanese yen, and it's basically high basing up there. So that doesn't speak to a US dollar problem. That says, hey, maybe we're on the cusp of another break to the upside. Kind of a high base, little ascending triangle there in US dollar against the Japanese yen. If we look at the euro against the US dollar, bouncing the last couple of days, but again, the dominant trend is euro weak, US dollar strong, still below the 20 period MA, weak enough to do that. British pound, same thing, bouncing a little bit today, but still definitely in a downward trend. Now, where there has been some strength has been, and I've mentioned this, I think the commodity currencies, I really like commodities here, and precious metals may be my favorite, but oil, we've been on board with that. And so of late, you've seen a big change the last week or two where Aussie and Kiwi and CAD are just fantastic. And I didn't pick the turn perfectly, admittedly. I thought, you know, back here you just trade the trend, but I got on board with this idea of Aussie, CAD, Kiwi going up in the last week or so, and that's been the right trade. So Aussie USD, Kiwi USD, CAD USD. What each of those have, though, while they're rallying, so they're all stronger than US dollars, right? Kiwi stronger, Aussie stronger than the USD of late. Here's USD CAD, so it's flipped around. USD weak, CAD is stronger, so they all show the same thing. USD CAD isn't really setting up, but what do both of these have? These have, on the daily chart, the proprietary system that I use, which is the Bollinger Band system. You're below the 50 MA, so the dominant trend is down, but you're overbought in an otherwise downward trend. You're at the upper Bollinger Band. The probability of this, seeing some give back, is pretty high. So this is Kiwi USD. Here's Aussie USD. It's the same price pattern. And really what these might be, I don't know if this is exactly how it's going to go, but if you kind of look at this, and I didn't draw that line exactly where I wanted, if you look at this in terms of the range, we're basically in something like Aussie USD at an important inflection point, because this was the major support previously. This was the breakdown zone. This was where you retested and failed. Old floor becomes new ceiling, right? Old support becomes new resistance, and we're right back there again. Do we make and take off to the upside, or do we fail and give back these gains and head back to the lower end of the range and so forth? Well, remember, my friends, the dominant trend is still down. So this is an area where I think we could potentially fade this rally in something like Aussie USD. Now, if you just want something that's still working, maybe you go dollar yen or something like that. This one's a little bit more speculative, admittedly, but we can look at it from the standpoint of just a trade opportunity. So one thing that I would do is maybe look at the total size of this and expect it to pull back maybe half of that candle. Now that doesn't sound like that much, but it's actually a decent little risk to reward, because if you look at this from the standpoint of numbers, it's about 64.75 is that midpoint. 64.75 from its current 65-ish level is 25 pips, which on a percentage basis on Aussie is pretty darn good. A 25 pip move in Aussie is pretty awesome, right? It's a lower cost currency. It's a little bit more valuable proposition. Now, if you wanted to trade something with a little bit more pips, it's not going to be worth as much per pip, but you could say, well, maybe pound gives back. Pound would probably move about 50 pips or so back down. But again, it's twice the price. So in essence, it's the same trade. It's a similar dynamic. But I like Aussie USD, Kiwi USD on the short side, just in the very short term as a potential idea. Maybe a little fade the rally type of dynamic, and we wouldn't risk much. I mean, I don't know that I would put my stop above today's high, but that's only 65.11. So you're talking about, if you put it above the high, you're risking like 12 pips to make 25 in the very short term, and it should happen quickly. Something like that could be in play. If you had a little bit longer time horizon, I suspect the Bollinger Band system suggests that this could go 150 pips lower, which would be obviously a massive move, a big reward type of dynamic. Then you might risk 30 pips to make 150 or something. But very short term, we're just trading around the Fed meeting. That's something to consider. If we look at something like pound sterling, same type of idea, but on the 4-hour charts, you can see some of these setups. And is the yen also? I didn't notice that one, but I did notice pound. I did notice the pound versus USD earlier. If we come into the 4-hour, same type of dynamic. Now, look at how this has worked in the past. The 50-period moving average is the blue line. So whenever you're below the blue line, if you hit the upper Bollinger Band and you're still below, that's a short. So here's a short setup. Phenomenal. Look at how it went lower. Here's a short setup. Phenomenal. Look at how it went lower. So we've had two in the last few weeks. We've got another one. Now, I would say that this one may not look quite as kind of, we've had a little bit sharper rally into this, but I would still trust it more than not that we're going to make another leg lower. But you can see how the two prior. Now, somebody might say, well, what about these ones up here? No, you have to be below the 50. What about right in here? No, it never touched the upper band, right? So this criteria, this never triggered, even though it would have been a good downside trade. And back here, you weren't in the downtrend, you weren't below the 50. So the two spots were right here and right here that triggered that setup. Mark pointed out that the Japanese yen, I did not notice that one, but there you go. So there's the 4-hour chart on dollar yen. We looked at the daily. Remember, the daily's in that high base. I mean, this one might be the most obvious trade. This might be the trade today, frankly, because not only do you get the upside, you've got a little bit, stronger picture in both the short term, intermediate term, long term. It could be the play. My only word of caution would be to just play it short term. I don't really love shorting Japanese yen right now because the Bank of Japan has intervened, and whenever you've got central banks intervening in the currency landscape, it creates more volatility, but it's not good volatility. It's unpredictable volatility, which is the worst kind. Unpredictable volatility is what happened in the Swiss franc, as an example. What happened? They removed their peg to the euro and it moved massive percents, right? That's volatility, but it's not any sort of volatility that you can really manage. And so I feel the same way about Japanese yen right now. As I just I I don't love it. I'm not really trading it a lot because we didn't trade the Swiss franc back when they were pegged to the euro, and we probably saved our traders enormously because we just wouldn't trade that currency during that phase. And that was the widowmaker, right? That just set some people out of the business if you were on the wrong side of the trade. Well, Japanese yen, you got to be a little careful because, again, there's central bank intervening in currencies, and that can create unpredictable volatility. So that's one reason I'm not following the yen real closely and looking at some of these others. But for a short-term trade, that one could be considered. So all of these, I think, are worth a look. Be it pound USD on the short side, we would be playing this 4-hour chart. We would be looking to short somewhere in here, stop loss up above, and at least a target back towards the lower end of the band. And you probably have about a 2-to-1. Here's your risk, here's your reward, and it'd probably be about 2 times the reward as to the risk. Something like that perfectly makes sense. I'm going to see if we can see something with Aussie USD, which admittedly, when you come into these shorter term charts, this is what I was saying, is it's not really set up necessarily on the short term charts. It's more a dynamic where you feel like you're at the top of the range, and that just for today, the Fed jawboning can kind of knock it down. We won't be in this. In terms of our FOMC trade, we're only going to be in this for, a couple hours maybe, a few hours, something like that would probably be about as long as we would be trading this. So we've got the meeting coming up here. Let's look. Okay, so we had a request. Let's take a look. So dollar CAD, I just didn't like it as much. I've liked the CAD as being my favorite currency for a while there. And oil prices are one of the benefits. Precious metal, it's just in a good spot recently. But if you look at it, it's weak enough, USD is, that it's pierced the 50 MA. That's why I'd much prefer the Aussie and the Kiwi. It has the true setup, whereas this shows vulnerability to the CAD overtaking the US dollar entirely, the entire trend changing and such. So it's just not, it speaks to how strong the CAD has been, and it's not my favorite currency to be short right now. So I would, if going into those, I would prefer Aussie or Kiwi for sure. That's just me personally. So I think we've got 3 potential ideas, and all of them are on the side of dollar going up. But here's the tricky part. You really have 2 meetings. You have the statement, which comes out at 2. You have the press conference, which starts at 3. And I'll be darned if they don't trade opposite to each other often. Whatever the reaction is here, I mean, sometimes the Fed just completely derails that. So what I'd actually like, I would love it if USD sort of popped down a little further. It's right, it's selling off today. Pop down a little bit further, and then maybe we fade it to have it pop back up and get that press conference causing it to pop even further. That would be my thought. Now, it will move quick here. You want to have things ready. I don't trade off of this screen, but if we were going to trade off this screen, you'd want to have some things ready. Like you'd want to have your sell short here somewhat ready in Aussie USD. Let's pull it up. You know, however many, say you're trading 3 lots or something. We could have bracketed stop and targets, right? So we could say we're going to target a move down to 64. It was about 75. And the stop was going to be somewhere up. Again, just a little higher, nothing too major. But we might have something like this where that gives us about, I mean, that's only 11 pips of risk and gives us about 28 pips of reward. Something prepared, something ready that you can just transmit that order if you feel like it's there. And the way I do it is with a limit order. I say, okay, I'll be willing to short at 65.03 or 65.01 or whatever the lowest I'm willing to go is, and then I can just hit transmit and it'll execute if it's above that price. So even if it's at 65.07, it'll execute at 65.07 if that's where the market's at, because I said I want to short it at that price or better. And since it's at a better price, it'll execute. Now, if it moves too fast and it shoots down, then maybe this order doesn't get filled, and that can happen, right? We want to see some energy and whatnot, but we could have something prepped. I wouldn't even mind having my stop a little bit wider and then tightening it up immediately. But just in case we still want to execute when it's at 65.10, you don't want to be immediately stopped out, you know, so you can give it a little bit of room, and then as soon as you get filled, move that stop to exactly the spot you want it. Have some things ready that way. I would do the same thing if we were trading pound. Have something prepared where you say, okay, let's build a short, and then let's put a stop and a target around that and so forth. So again, we won't be actually executing from this screen. I may be doing some things on my other screens, but we'll be watching accordingly. Yeah, it would be a little pop and drop. So if you were looking at one of these charts, it would be just a little bit more surge to the upside and then start to fade off is the general idea. Here we're on daily charts. If you came into the really short term, you know, maybe even something like dollar yen or whatever, and maybe 5 minutes a little too tight, but anyway, you'll see it move. Dollar yen, so as soon as this announcement comes out, which we're only about a minute away, if this pops up, dollar's getting strong. If this pops down, US dollar's getting weak, right? So we could just watch a chart like this and instantly see. It'll also tell us about energy. Is it moving rapidly? Does it jump? Does it spike? Or is it just, sometimes you'll see it and you're like, wait, has the announcement already come out? Has it already done? Because it just isn't moving. And so there's usually a little delay of a few seconds, but it should be running rapidly. And right off the bat, we'll just want to gauge whether US dollar is acting strong or weak. So here we go. Immediate dollar strength. Do you see that? Look at that burst. So USD strong. It's exactly what we kind of philosophized that maybe we'd have a chance here. So I would transmit this type of order. And I'm going to do some stuff on my other screen, but I would be looking to get short Aussie USD or pound USD, whatever your trade is. I'm focused on Aussie, and we would want to transmit and get prepared, get ready for the order. Now, in this particular case, it is kind of running away from us just a bit. So if we come back to it, I mean, it's just really spiked, a big burst higher in US dollar. I suggest, remember when they released that statement, the algos are looking for words and commentary and so forth. Now here's the problem. It's already triggered the target. So if you were in the trade, fantastic. You've already got a profit. Well, now we need to go to plan B because obviously our trade was spot on in terms of idea. The problem is it didn't get an execution. It just moved so rapidly. Well, that's the risk to reward of you could be in the trade into the announcement, but that can be crazy volatile, right? So we tried to get the order executed. I did not get an execution personally. So just put that into perspective. It moved and it never. What will happen a lot of times is you'll see that burst. You kind of saw it. It burst and then it popped back up just temporarily, and it only missed my trigger by a few pips, but it missed. So anyway, that first trade is done. Now, well, what's the next idea? Like we said, this is really something that you could swing trade, meaning I very much like it. We believe in this system that this bearish Bollinger Band setup, it's more likely to trade down here to the lower band and resume its downward trend and that sort of idea. So you have an excellent risk to reward, still getting short somewhere in here because your reward potential still another 125 pips to the downside, down there towards 63.50. And your stop up here above the highs, still only 20 or 30 pips or whatnot of risk. So the risk to reward on it from a swing trading perspective is still attractive. Be it you could short Aussie USD, you could short Kiwi USD, same price pattern. You could even go long dollar yen, but again, I avoid that because, well, we already discussed it's got that volatility that hard to wrap your arms around. But those would be the dollar yen, by the way, is not a Bollinger Band setup. That one is just purely based off of a high base triangle, ascending triangle, whatever. So if you were using the Bollinger Band system, it's either short Aussie USD or short Kiwi USD as a swing trader. Yeah, I mean there may be a reversal here. Absolutely, there may be another trade, another short-term opportunity in half an hour because that's what we've seen. It's been quite wild the way that that's happened, but in the Fed meetings, the initial reaction has often flipped a 180. Now, I don't know if that's going to happen this time. As I said, I thought the Fed would release a statement that had a very hawkish tone, that we knew they weren't going to change rates, but the question is, were they going to signal to the markets that maybe they're not done and they're very much focused on still raising rates, et cetera, et cetera. And I think that's what's happened. So it's one of those situations where I think the dollar should strengthen for a period of time. And it makes sense because they need to get inflation under control. They're still behind the curve a little bit. They're still not where they want to be. 3.7% and going higher is not what the Fed wants. So we'll see. But interesting times we're living in. All right, well, we'll leave it there. Hope you enjoyed today's FOMC meeting. A little unfortunate we weren't able to capture that because The whole theory, philosophy, everything was really lined up for it. Just didn't quite have the opportunity and the setup to get a trigger. Thanks. Have a great rest of your day, and we'll see you next time. Goodbye, everyone.